Forget the 401k and the IRA for a minute. There is one specific account with triple tax benefits that the wealthy use to shield their money from the IRS, and you probably aren't using it. Millions of Americans mistakenly believe this account is just a plastic debit card used to buy aspirin. They are completely wrong. Today, we are uncovering the ultimate stealth wealth vehicle in the United States tax code and how to weaponize it. To understand why this specific account is the absolute holy grail of personal finance, we must first confront the most terrifying financial reality in the United States. You can do everything right. You can budget perfectly, you can invest in the S&P 500, you can pay off your mortgage, and you can build a massive traditional retirement account. But there is a silent monster waiting for you at the finish line that can wipe out 30 years of hard work in a matter of months. The American healthcare system. According to the latest comprehensive studies by Fidelity Investments, an average perfectly healthy 65-year-old couple retiring today will spend roughly $315,000 in out-of-pocket healthcare costs throughout their retirement. That is not a typo. That is over $300,000 of pure cash, completely separate from what the government covers. Millions of people falsely believe that once they hit age 65, Medicare activates and all their medical bills vanish. This is a catastrophic illusion. Medicare has massive gaps. It does not cover routine dental care. It does not cover vision, hearing aids, and most importantly, it does not cover the astronomical cost of long-term nursing home facilities, which can easily exceed $10,000 a month. Medical debt is the #1 cause of personal bankruptcy in the United States. If you pull $300,000 out of a traditional 401k to pay for these hospital bills, the IRS is going to hit you with massive income taxes on those withdrawals. You will go broke trying to stay alive, giving a massive percentage of your wealth to the government. You need a dedicated, heavily armored, completely tax-free medical war chest. That fortress is the health savings account. The absolute biggest reason 90% of the population ignores the HSA is due to a tragic structural naming confusion. When human resources departments hand out benefits packets, employees see two acronyms that look almost identical: the FSA and the HSA. Millions of people confuse the two, and they assume the HSA has the exact same toxic rules as the FSA. We must draw a hard line right now. FSA stands for Flexible Spending Account. This account is a trap. It operates on a brutal use it or lose it legal mandate. If you put $2,000 into an FSA, you are legally forced to spend that money on medical expenses by December 31st of that exact same year. If you stay healthy and you do not spend the money, the government literally confiscates your unspent cash at midnight. It vanishes. Because of this, people are terrified to put large amounts of money into these accounts. HSA stands for Health Savings Account. It has absolutely nothing to do with the FSA. The HSA is your money forever. There is absolutely no use it or lose it rule. If you put $4,000 into an HSA today and you do not go to the doctor for 25 years, that money stays in your account. It rolls over from year to year, from decade to decade. If you change jobs, the account leaves with you. If you retire, the account stays with you. It is a permanent, fully sovereign, lifelong investment vehicle. You must never confuse the two again. Because this account is so incredibly overpowered, the Internal Revenue Service does not just let anyone open one. There is a strict gatekeeper blocking the entrance. You cannot simply log into a brokerage account and open an HSA because you want one. To legally qualify to contribute to a health savings account, you must be actively enrolled in a very specific type of medical insurance known as an HDHP, which stands for High Deductible Health Plan. When you choose your medical insurance at work or on the open marketplace, you generally have two options. You can choose a premium plan, which has a very high monthly cost, but a very low deductible, meaning the insurance pays for almost everything immediately. Or you can choose the High Deductible Health Plan. An HDHP has an incredibly low monthly premium, meaning very little money is taken out of your paycheck. However, the catch is that if you get sick or injured, you have to pay a massive deductible, often several thousands of dollars out of pocket, before the insurance company pays a single dime. So who is this actually for? The HDHP and the accompanying HSA are absolutely perfect for two types of people. First, young, healthy individuals who rarely visit the doctor. Why pay a massive monthly insurance premium if you only go to the doctor once a year for a standard checkup? Take the cheap plan and put the massive savings into the HSA. Second, it is for financially stable individuals who have a fully funded emergency cash reserve. If you have $20,000 sitting in a high-yield savings account, a $3,000 medical deductible doesn't scare you. You gladly take the high deductible specifically so you gain access to the holy grail of tax accounts. Now we arrive at the absolute core of the strategy. Why do billionaires and financial experts obsess over the HSA? Because it possesses something that no other account in the entire United States tax code has. It is the only account in existence that is triple tax advantaged. Let us break down exactly what that means. Look at the three pillars on this slide. Advantage number 1, tax-free in. Just like a traditional 401k, the money you contribute to an HSA is completely pre-tax. If you make $80,000 a year and you put $4,000 into an HSA, the IRS lowers your official taxable income to $76,000. You get an immediate massive tax break today, saving you hundreds of dollars in income tax this April. Advantage number 2, tax-free growth. Your money does not just sit there as cash. You invest it in the stock market. As it grows and compounds over 30 years, the government legally cannot touch it. If your index funds pay dividends, there is no dividend tax. If the stocks explode in value, there is zero capital gains tax. Advantage number 3, tax-free out. This is where the magic happens. With a traditional 401k, you pay massive taxes when you pull the money out in retirement. With the HSA, as long as you use the funds to pay for qualified medical expenses, the withdrawal is 100%, completely legally tax-free. It completely evades the IRS at every single level. You avoided taxes when the money went in. You avoided taxes while the money grew. And you avoided taxes when the money came out. It is the ultimate impenetrable tax fortress. If 3 tax advantages were not enough, there is actually a highly guarded, hidden 4th tax advantage that makes the HSA mathematically superior to even the mighty 401k. When you contribute money to a standard traditional 401k, you successfully avoid federal and state income tax. However, you do not avoid payroll taxes. Every time you get a paycheck, the government silently rips out exactly 7.65% for FICA, which funds Social Security and Medicare. Your 401k contributions are still subject to that FICA tax before they go into the bucket. The HSA operates under completely different rules. If you set up your HSA contributions to be automatically deducted directly through your employer's official payroll system, the IRS grants you a total exemption. Your HSA contributions completely bypass the 7.65% FICA tax. You dodge federal income tax, you dodge state income tax, and you dodge the FICA payroll tax simultaneously. This means that every single dollar you put into the HSA has the absolute highest retention rate of any dollar you earn in your entire life. It is the most efficient transfer of wealth from your gross salary to your net worth that exists in the American legal system. You must ensure you are contributing through payroll to capture this massive hidden benefit. Because the HSA is technically branded as a health account, 99% of the middle class uses it completely wrong. They ruin the mathematical magic before it even has a chance to begin. When you open an HSA, the bank will mail you a physical piece of plastic, an HSA debit card. The absolute worst thing you can possibly do for your financial future is to put that debit card in your wallet. Here is exactly how the amateur uses an HSA. They deposit $2,000 into the account. 2 months later, they go to the dentist to get a cavity filled, and the bill is $300. They proudly pull out their HSA debit card, swipe it, and pay the bill. They feel incredibly smart because they used tax-free money to pay for their teeth. Mathematically, this is a tragedy. You just treated the greatest tax shelter on earth like a temporary checking account. By immediately draining the cash to pay for a minor medical bill, you completely destroyed Pillar 2. Tax-free growth. The money never had a chance to compound in the stock market. Here's exactly what the millionaire does. When the debit card arrives in the mail, they take a pair of scissors and they cut it into pieces. When they go to the dentist and get a $300 bill, they do not touch the HSA. They pay the bill out of their normal, everyday personal checking account. They absorb the short-term pain in their cash flow so they can leave the money inside the HSA permanently untouched. By refusing to spend the HSA cash, they lock it into the stock market and let it multiply into a massive fortune over the next 30 years. This brings us to the ultimate stealth wealth hack. This is the specific loophole that millionaires use to mathematically crush the system. When you go to the doctor and get a bill for $100, you do not use the HSA. You simply pay the $100 out of pocket, using your normal standard checking account. But then you do something incredibly important. You take the receipt for that $100 medical bill, you scan it, and you save it in a secure digital folder on your computer. You label the folder HSA Unreimbursed Expenses. Why do you do this? Because if you read the actual Internal Revenue Service tax code regarding health savings accounts, you will find a massive, staggering loophole. There is absolutely no time limit on when you can reimburse yourself for a qualified medical expense. Let me repeat that. There is no time limit. As long as the medical expense occurred after you legally opened the HSA, you can reimburse yourself tomorrow, next year, or 30 years from now. So you pay out of pocket today, you save the receipt. Meanwhile, that $100 you left inside the HSA is sitting in the stock market, aggressively compounding. Over 3 decades, it grows into thousands of dollars. 30 years from now, you will be sitting on a massive tax-free fortune. You can literally open up your digital folder, calculate that you spent $30,000 on various medical bills, co-pays, and prescriptions over your entire adult life, and legally withdraw $30,000 of pure, untaxed compound growth from your HSA to go buy a boat or travel the world. You're using your past medical bills as a tax-free ATM machine for your future. If you are hesitant to absorb the short-term pain of paying for your medical bills out of pocket, we must look at the brutal, undeniable mathematics of compound interest. Look closely at the 30-year simulation on your screen. This is the difference between the amateur and the millionaire. Let us assume the maximum legal contribution for a single individual is around $4,150 a year. The amateur deposits the $4,150. Over the course of the year, they get sick, they buy prescriptions, and they swipe their HSA debit card to pay for it all. At the end of the year, the account is at zero. They do this for 30 years. They successfully paid their medical bills, but their wealth generation is absolutely zero. They have nothing saved for retirement. Now look at the green compounding curve of the millionaire. The millionaire also deposits $4,150 every year, but they never swipe the debit card. They pay their hospital bills out of their normal checking account, and they invest the HSA cash entirely into a broad market S&P 500 index fund. Assuming a historical 8% return, the math is staggering. Over 30 years, the out-of-pocket contribution was about $124,000. But the magic of compounding generated over $380,000 in pure, untouched profit. The millionaire arrives at age 65 with a tax-free medical fortress worth over $500,000. They can use this massive vault to pay for luxury nursing homes, premium healthcare, or they can cash in their 3 decades of saved digital receipts to pull out hundreds of thousands of dollars tax-free to buy a beach house. You must let the money compound. A common objection people have at this point is, what if I am perfectly healthy? I don't want to trap all my wealth in an account that I can only use if I get a terrible disease or need open-heart surgery. This fear is completely unfounded because the IRS definition of a qualified medical expense is astronomically broad. It covers nearly everything related to the maintenance of the human body. Under IRS Section 213D, qualified expenses are not just hospital beds. Do you wear glasses or contact lenses? Every single eye exam, every pair of prescription sunglasses, and every bottle of contact solution qualifies. Did you get LASIK eye surgery? That qualifies. How about dental care? Routine teeth cleanings, fillings, root canals, and braces for your children are entirely covered. It covers all prescription medications, physical therapy, chiropractic care, and recently the law was changed to include over-the-counter medications. You can literally use tax-free HSA money to buy Tylenol, Advil, cough syrup, and basic first aid kits at the pharmacy. Furthermore, when you reach retirement age, you can use the HSA to pay for massive structural expenses. You can use it to pay your Medicare Part B and Part D monthly premiums. You can use it to pay for incredibly expensive long-term nursing home care. When you look at this massive list of everyday items, you realize that it is mathematically impossible for you not to use this money over your lifetime. Every human body depreciates. You are guaranteed to need vision, dental, or pharmaceutical care eventually. The HSA simply ensures you pay for it with tax-free growth rather than your hard-earned income. But let us play devil's advocate. Let us imagine the absolute extreme scenario. What if you possess superhuman genetics? What if you never need glasses, you never get a cavity, you never need a hospital, and you arrive at age 65 in perfect physical condition with $500,000 compounding in your HSA? Is your money permanently trapped in medical jail? Will you die with $500,000 you were legally not allowed to spend? Absolutely not. The IRS built the ultimate safety net directly into the tax code. The magic number for the HSA is age 65. The absolute second you celebrate your 65th birthday, the strict medical restriction completely disappears. At age 65, you are legally allowed to withdraw money from your HSA for any non-medical reason whatsoever. You can use the money to pay your mortgage, buy a boat, take a cruise around the world, or go to a casino. What is the catch? If you use the money for a non-medical reason after age 65, you simply pay standard ordinary income taxes on the withdrawal with absolutely zero penalty fees. Do you realize what this means? It means that at age 65, the HSA magically transforms into a standard traditional IRA. You literally cannot lose. It is a completely risk-free proposition. It is either the most powerful, tax-free medical shield in the history of finance, or worst-case scenario, it just acts as a massive bonus traditional retirement account. There's absolutely no scenario where your wealth is permanently trapped. As you set up this system, you are going to encounter a massive logistical frustration. Because your HSA is tied to your employer's high-deductible health plan, your HR department will force you to open the account with their specific chosen corporate provider. Historically, corporate HSA providers are absolutely terrible. They are notorious for charging monthly administrative fees just to keep the account open. Worse, they often require you to keep a massive cash minimum, like $2,000, before they even allow you to invest a single penny. And when they finally do let you invest, they restrict you to a terrible menu of expensive mutual funds with high expense ratios. They are actively draining your wealth, but you are not trapped. You can execute the periodic rollover hack. Here is exactly how you bypass the corporate trap. You must keep the employer's terrible HSA account open because you absolutely need your contributions to route through their payroll system to capture that massive FICA tax bypass we discussed earlier. However, you go to a premium, low-cost brokerage like Fidelity Investments, and you open a second, completely free personal HSA. Fidelity charges zero fees and lets you invest every single dollar immediately into incredibly cheap S&P 500 index funds. Once or twice a year, you initiate an electronic transfer. You instruct Fidelity to legally reach into your corporate HSA, pull the massive pile of accumulated cash out, and roll it directly into your personal Fidelity HSA. You leave a few dollars in the corporate account to keep it open, but the vast majority of your wealth is instantly liberated. You get the payroll tax benefits of the corporate account, combined with the total investment freedom and zero fees of the personal account. With so many powerful retirement accounts available, you must deploy your capital strategically. If you have a limited amount of money to invest every month from your paycheck, you cannot guess. You must follow the exact mathematically optimized sequence known as the order of operations. Look at the blueprint on the screen. This is the exact sequence the wealthy use to shield their money. Step 1. Capture the employer match. You go to your company's 401k and you contribute exactly the percentage required to get every single penny of the company match. If they match up to 5%, you put in exactly 5%. You capture the 100% ROI and then you immediately stop funding the 401k. Step 2. Max out the HSA. This is where the magic happens. You direct your payroll cash flow aggressively into the health savings account until you hit the maximum annual IRS limit. You secure the triple tax advantage, you bypass the FICA payroll taxes, and you immediately invest that cash into broad market index funds to begin compounding. Step 3. Max out the Roth IRA. Now that you have the free corporate money and the ultimate medical shield, you want sovereign individual control. You fund your personal Roth IRA up to the limit. This guarantees that you are building a massive pool of cash that the government can never, ever tax in your old age. Step 4. Return to the 401k. If you are a high-income earner and you still have money left over after maxing the HSA and the Roth IRA, you circle back to your employer's 401k. You pump all remaining cash into that bucket, attempting to hit the massive $23,000 legal limit. If you execute this exact 4-step sequence consistently for 20 years, it is mathematically impossible for you to fail. The American tax code is incredibly brutal to the working class, but it provides massive legal escape hatches for those who take the time to learn the rules of the game. For years, the health savings account has been ignored by the general public as a boring, administrative medical annoyance. Meanwhile, millions of highly educated, wealthy investors have been quietly maxing out this account, aggressively investing the funds in the stock market, and hoarding their medical receipts in digital vaults. They are actively building multi-million-dollar tax-free empires right under the radar of the Internal Revenue Service. You now have the exact blueprint. You understand the math of the high-deductible health plan. You know to never use the plastic debit card to pay for current expenses. You know how to capture the secret FICA tax bypass through your payroll department. And you know how the age 65 escape hatch guarantees you will never be penalized if you stay perfectly healthy. Do not leave the greatest financial loophole in America completely empty. Log into your HR portal during your next open enrollment. Calculate the math on a high-deductible health plan. Turn on your HSA contributions, buy the index funds, save your receipts, and take absolute control of your financial destiny.